companies that are actually directly sort of like dependent on patents and copyright and stuff like that. However, there's a whole bunch of other firms, including in the non-durable goods production industry or the retail industry, that are reliant on intangible assets as well. And most of the time, these firms are at the top of global value chains as well. Now, when we're talking about the knowledge monopolization, why the issue is important, we can actually kind of see this in relation to the three main debates in the macroeconomic literature within the last decade or so. One of them was this idea that the world, after the global financial crisis, the world economy has been in some sort of a secular stagnation. And when people talk about the secular stagnation, essentially, when you look at the growth rates of the major economies in the world, you see that from the 1990s to the 2000s and 2010s, there seems to be a decline in most of the areas of the world in terms of the average growth rates. Mostly this sort of like, if you essentially take East Asia out of the picture, then you see a downward trend in the growth rate. So this is usually referred to as the secular stagnation in the literature. And there's a tons of papers that are sort of tackling this issue, trying to understand what could be the essential drivers of stagnation in this context. Now, the second macroeconomic debate, one of the recent debates, has been on the widening inequalities, and we all know this is just an example from the U.S. The share of the top 1% within the total net worth of the U.S. economy, and that has been increasing since, if you kind of like put a trend here, it's been increasing since the early 1990s, but it really picked up in the 2000s. There's a brief pause here, but then, sort of like continues going up. So it's like, it almost seems like something happens in the early 1990s that sort of like starts this trend as well. And then the third debate, again in the macroeconomics literature, both in the US and Europe, has focused on whether the large corporations have actually now have much more market power compared with the earlier periods. And this is just a summary of the changing concentration ratios from 1990s to 2000s. And there's different ways of measuring the concentration ratios, but no matter how you measure it, no matter how many firms you put in the top group, essentially what you see is an increase in the market concentration in the US and to a certain extent in the European economies as well. So these three trends can actually be partly explained by the developments in the area of knowledge monopolization. One of the things, if you look at the secular stagnation idea, is that one of the main sort of like puzzles, so to speak, in the secular stagnation debate is the fact that most non-financial corporations, despite having high profitability, have not been increasing their fixed investment as much. So this is usually referred as the profit investment puzzle in the literature. And one of the things that you see for the advanced economies is essentially that it's not, of course,
tangible. One of the things is that if you actually closely look at the data on the firms, what you observe is that even though the tangible investment ratios are not increasing that much in tandem with the profitability increases, intangible
and there is this issue or the debate in terms of whether investment in intangible assets, or more specifically in intellectual property products, essentially increase or decrease innovation, so to speak. Now, there's of course
the Schumpeterian arguments, which are interpreted by some as innovation is going to come out of large corporations that actually have secured enough internal funds and that kind of stuff. But then if you actually look at the actual sort of like innovation measures, such as the patents and their contents and so on and so forth, what you see is that this process also includes what's called an evergreening, mostly referred in the pharmaceutical industry, which doesn't include real innovation, but is designed to add, little bits and pieces to a certain patent in order to extend the life of that patent. And then there's the issue of whether innovation is actually made in order to generate new products and new processes and those kind of things, or whether innovation is essentially under the guidance of these knowledge monopolies directed to protecting market power. Okay. And in most cases, what you see, what we observe, I'm going to show it in the pharmaceutical case as well, most of the innovation that these big companies do, as we see them, like, when they come to the market, are either outsourced to smaller companies, smaller research labs, public institutions, universities, and so on and so forth, or they essentially buy these innovations that take place in other places. Now, this is for the US, of course. For the developing countries, another consequence is that when you increase the scope of the intellectual property protections, you're essentially limiting the investment opportunities in developing countries as well, and forcing the firms in the developing countries to specialize in the so-called lower value-added components of the production process. In a way, when you think about the Chinese economic development, you can kind of like see the significance of the IPRs in development, in the sense that one of the major debates in the last few years have been the trade wars between the US and China. And these trade wars essentially come to the issue of whether China is implementing the intellectual property rights the way that the US and the WTO demands. And China has been kind of like quite resisting that for a long time, in order not to limit its investment and development options. Now, the second debate, the widening inequalities debate, essentially takes into consideration some concentration that's taking place in the American economy. But if we're talking about knowledge monopolization, then we need to talk about how these monopolies are essentially acquiring rents from different groups and classes in the society. So it could be actually like getting it from the consumers, it could be getting it from workers, but it could also be getting it from other smaller establishments, smaller capitals, and developing economies as well. So if we agree that there's some sort of a monopolization process going on at the top, then it comes with rents that are created, that are generated as a result of this process. And those rents essentially have to come from somewhere. And these are the potential places that, so if you think about that, this would be a phenomenon that would also contribute to increased income and wealth inequalities at the same time. Now, finally, if you look at the debate on the increased concentration and increased market power of the large corporations, you can clearly see a relationship between knowledge monopolization and increased market power in many industries. Now, there's a couple of ways that the IPRs do this, increasing market power. And one of them is what we can call a process of enclosures, or a process similar to the enclosures, in the sense that a large number of markets and products are actually protected by very sort of like strict IPRs that is preventing the entry of many companies into these areas. Second, in many cases, the IPRs are essentially working to create artificial scarcity for products whose marginal costs are zero or near zero. if you think about like products like, I don't know, for example, software and stuff like that, where once you produce one unit of that software, production of the second unit is almost costless, and the third unit and fourth unit. So if the price was supposed to be equal to the marginal cost, then what you would have would be like for the prices for most of these products would actually approach to zero. However, by creating artificial scarcity in these products, and this is not only done, of course, by the IPRs, but a lot of technical stuff is also used more recently. But the IPRs are the main sort of legal means of creating scarcity in these markets, just so that the price actually is above zero. Now, the third way is, in most cases, this is sort of like a concept that comes from Naomi Klein, right? The brand name capitalism, in the sense that in many cases, trademarks and brand names and copyrights and stuff like that are used not to generate value or generate actual new products and stuff like that, but monopolize certain parts of the market. And this is the case in most products in the non-durables industry. If you look at it, think about like from shoes to like whatever you can think about. There's very little innovation there, but a lot of market power by certain companies that are essentially not even like producing these products, but outsourcing them to. So the exact same product, the exact same shoe will have different prices depending on what's actually written as the brand name on top of them. And then, of course, you can add the standard sort of like monopolistic pricing and stuff like that to this picture. But basically, in addition to this, the knowledge monopolization process generates new barriers to entry into many industries as well. If you're a large company that has acquired a large number of patents, then you can essentially form what's called like patent thickets, which make it extremely difficult for other firms to enter into the production of certain things without violating one or two patents. And then if you actually have an army of lawyers at the same time, this is going to reflect itself essentially by discouraging many smaller firms to even attempt to enter into this process. And then on top of that, of course, at the end of this process, the large knowledge monopolies essentially produce and hold large amounts of cash in their accounts. And on top of that, they have the ability to borrow large amounts of cash from the banks as well, using a lot of intangible assets as collateral, which then puts the acquisition threat on the table as well, which then forces many small companies, this is especially obvious in the high-tech case, pushes the companies to focus on a single product, develop a single product that they hope that they're actually going to sell to one of the large companies at the end of the process, rather than actually developing something else that's going to compete with the dominant firms in that industry. Now, one little thing, maybe one little note here, in the sense that knowledge monopolization doesn't necessarily mean that competition is being eroded in these markets. In fact, if you look at it closely, these large knowledge monopolies are also in a very intensified competition over IPRs among themselves as well. So it's kind of like the dialectics of the thing is that on the one hand, you have increased monopolization, but now that actually leads to even more intensified competition among these very large corporations. So the knowledge monopolization, in short, is a useful concept at the very least when we're trying to engage in these three different debates that have been going on in the macroeconomics, including secular stagnation, increasing inequalities in income and wealth distribution, as well as the increased market power and concentration in the advanced economies. Now, what we did was, based on this background, what we did was to look at one of these industries, that is the pharmaceuticals industry, and with a simple question of whether there's a relationship between the profitability of the drug companies and the actual drug innovation that they undertake. Now, why asked a question like this? First of all, if you look at the pharmaceutical companies, what you see is, among the non-financial industries, the pharmaceutical industry is one of the most profitable industries. If you look at their markups, you'll see that they have almost the highest markups, which is reflected in really high drug prices, especially in the US. And at the same time, it's one of the most knowledge-intensive or R&D-intensive industries. Yet, there is a discussion on the pharmaceutical industry, looking at the innovation rates in the pharmaceutical industry and saying that the innovation rate in the pharmaceutical industry has been declining. Now, this is a curious case in the sense that the two arguments essentially in favor of intellectual property rights, and both of these arguments apply directly to the pharmaceutical industry. The arguments are these: the firms who essentially invest a large amount of their funds into research and development do this with the incentive of getting something out of this at the end of the process. So high profits or high markups are either defended as an incentive for innovation, or with the argument that the research and development process takes a lot of time and it's costly. Therefore, at the end of the process, if these firms are not awarded with high profits, then they cannot continue to invest in R&D and make innovation. So high profits will both give you incentives and the funds to carry on research and development. And so we ask a simple question: are these claims true? Do high profits and markups really lead to higher innovation in the case of the pharmaceutical industry? How do you do this? Well, what we do is basically we take three databases and merge them. This one is familiar for most people, I suppose. The CompuStat database has all the financial data on pretty much all the firms that operate in the US, Canada, Northern America. And then we take the patent data from a database called PatentView. But more interestingly, we then go to the Food and Drug Administration of the US, which essentially approves, observes, supervises, and approves all the new drugs and stuff like that. Now, what they have is a database of all the new drugs that have been approved since, I think we go all the way back to early 1980s or so. So what we do is, from here, we formed a sample of all the pharmaceutical firms in the US that had that innovated at least one new drug from 1980 to 2018. And what we do basically is, I can talk about the data and stuff like that, but this is financial data is not interesting. That's sort of like easy to understand. But the FDA, this is sort of like the FDA data. So from the FDA data, we define, we make two definitions. One large definition of new drugs and a one more a narrower definition of the new drugs. So what the FDA does is it classifies all the new drugs into different types depending on whether they include a new molecular entity or a new ingredient, a new dosage form, a new combination, or whatever. So they look at what is new in these drugs. Some argue that, all of these could be considered actually new drugs, but some criticize this. They say, for example, new dosage forms and new combinations may not necessarily be actual new drugs, but they can be actually designed to produce new drugs that are essentially replacement of old drugs that are running out of patent periods and stuff like that. But no matter what, instead of engaging with that discussion, we call all of them new drugs, though that's our first definition of new drugs. And then there is in the literature a more sort of like narrower definition, which says for a drug to be considered new, it has to include a new molecular entity or a new active ingredient. So we call that as our second new drug category. So we look at both of them essentially. The other stuff is like all financial. Just to give you an idea now, let me just start with the pharmaceutical industry and how it looks compared with the average non-financial firm. So this darker line in all the graphs is the average markup rate for all non-financial corporations in the US, other than the pharmaceutical industry firms. And the dotted line is the markup rate of the pharmaceutical industry. Now you can see the huge difference. And not only the pharmaceutical markups are like much higher than the average, but also they've been increasing over time, with sort of like happening quite fast here and then constant here, but over time it's increasing, resulting in profit rates that are much higher than the average non-financial corporation that you'll see in the US. So this gives you an idea of why a lot of people are like actually looking at the pharmaceutical industry from these eyes. And then you of course ask, like, what do they do with those profits? Of course, they are also really research and development intensive. They spent quite a large part of their income for R&D. But when I say quite a large part, of course, look at this axis as well. At the latest date, it was about close to 20% of their cash flow was spent on R&D. A significant portion of their cash flow, on the other hand, here it's almost close to 80%, of course, almost all the remaining money, that is used as either dividends or stock buybacks, essentially being given back to the shareholders. So that's sort of like an interesting case there as well. Now, when you look at this, what do you see? Let me just start with the patents. So this is showing the number of patents that these firms have been accumulating over time, okay? So the darker line is the number of patents that they get, and then, you see the trend with the dotted line. So, as you may expect, more R&D, more profitability, more R&D spending, and more patents. That's easy. And most of the literature, essentially, when they look at innovation and stuff like that, that is the stuff that they focus on. They look at research and development, and they look at patents as the outcome of this research and development effort. And then, if you put like R&D expenditures and the patents side by side, you can clearly see that there seems to be a positive correlation. However, if you put, there's another outcome here, the new drugs, and the again, the dark line is the narrow definition of the new drugs, and the dotted line is the much larger definition of the new drugs. So it looks at from 1980 all the way to just a couple of years ago, it looks at the number of drugs that were put in the market that passed FDA through FDA. And what you see for these firms is that there seems to be an increasing trend of new drugs in the 1980s all the way into 1990s. But after that, there isn't much increase going on. Now, even this, of course, compare this with the profitability tendency, right? The profitability is still very high. It's increased in 1980s, it's increased in 1990s, it's increased into 2000s, and kind of like stagnated in the towards the end of our sample years, but at a very high level, okay? Yet, what you see is that there's a little bit of increase in the new drug discovery when the profits are stagnating, and this is kind of like declining over time. What you can also do is you can look at the number of new drugs per patent over time. So what you see is that for the general type, there's a slight sort of like declining tendency, but for the narrower definition, there's a much sort of like steeper decline in that. What does this tell? This tells you basically that those number of patents that you've seen that's been going up is not necessarily showing new innovation, or it could be that the new drugs are like more complicated and requires a whole number of different patents and stuff like that. But no matter what the reason is, essentially, if you just look at the left-hand side, the number of patents here and the number of new drugs per patents are showing completely different directions. And finally, this is the number of new drugs per $1 billion of research and development expenditure by these firms. You can see how quickly they're sort of like falling down, and then both of them are like kind of like stagnating more or less from the beginning of 2000 or so. In other words, the productivity of the R&D dollars seem to have declined as well in terms of the new drugs in this period. Now, okay, if you don't like the graphs, what you can do is you can basically look at a couple of things side by side for the pharmaceutical industry here. Now, we're only looking at, this is very simple, decade averages. So 1980s, 1990s, 2000s, and 2010s. So divide the period into 4. And the average profitability for these top pharmaceutical firms is pretty much increasing in every period. And then, almost, more than doubles by the end of the sample period. And if you look at the R&D spending, the R&D spending seems to be a little bit increasing, but in the 2010s, the R&D spending as a share of their total cash flow is pretty much the same as in 1990s. What happens to the cash flow, though? What happens to the cash flow is that increasingly a larger portion of the cash flow is being given back to the shareholders, as I said, in the form of dividends and share buybacks. In the same period, the number of patents for these firms is increasing. The number of new drugs is more or less stagnant, if you look at by decade averages, okay? And then this is the last graph that I showed. The productivity of the R&D billions in some way, that has been significantly going down as well. Now, another way to look at it is, of course, in changes. And if you look at it in changes, then the outcome is staggering. The change in profitability is quite high. In the 2010s, the increase in profitability is around 42%. Change in average number of drugs. The first definition is negative. The second definition is quite low here as well. Okay. Now, being economist, you may not still be convinced by looking at the graphs and looking at the tables and stuff like that. So for those economists who are more inclined to look at scatter plots, you know, we have the scatter plots as well. But more importantly, of course, we have some regressions that look at as the dependent variable, the R&D, the new drugs, the large definition, and the new drugs, the much narrower definition. And for the control variables, of course, we have the market standard, you know, Tobin's Q, and we have the access to credit and access to finance or the indebtedness and stuff like that. And then we put like average profitability, the average 5-year profitability and stuff. Why average 5-year profitability? Because, you know, clearly innovation takes time. So you're not going to invest in innovation just because your profitability last year was high. So you're going to, you know, the idea is that if you have continuously high profitability, then the funds coming from here is going to go into 5 is some sort of a, you know, arbitrary period, it seems, but no, because developing a drug, essentially, this is coming out of the literature as well, the pharmaceutical, it takes on average 5 years. You can change this, you can make this 10, you can make this 3, you can make this 8. The results don't change, and we have those results as well. But at the end of the day, even the econometrics of all this does not show any significant statistical relationship between past profitability and future drug innovation at all. So this is sort of like the econometrics of the situation as well. This, you know, basically the same idea. Now, what do you conclude from this? Okay, what's happening is, no matter how you look at it, either descriptively or through averages or through firm level regression analysis, you do not see in the data the argument that high profitability leads to higher R&D and more drug discovery. In fact, the decline in pharmaceutical productivity is all the more puzzling, given that they are actually more and more profitable. And since the 19 that they receive have been increasing as well. The IPR protections have sort of like from the 1990s with the TRIPS agreement of the WTO have been widened to the whole world. So the number of patents are increasing. The increasing number of patents is not necessarily an indicator, at least in this case, of increased innovation. It's an indicator of increased intellectual property protections. Two, as we showed, the ratio of new drugs to new patents is also decreasing, right? What does this mean? This means that in the case of pharmaceuticals, the patent applications themselves are not a good measure of R&D. In fact, this data is more supportive of the view that the firms, essentially the pharmaceutical firms, use patents of dubious validity just to protect their market power and, you know, as I said, create entry barriers to the market. Finally, before we come to the final conclusion, third, another way to interpret this would be that, you know, you picked up the lower apples. Innovation is easier at the beginning, and once you're done, now the apples are much higher, so it's going to take, you know, like much more resources. So it's not necessarily a bad thing in terms of if you think about knowledge. You first do the easy things, you first make the easy discoveries. Now the diminishing returns in knowledge production and knowledge and R&D could explain these results if the new research now is targeting much more advanced drugs and more difficult sort of like treatments and stuff like that. Say you're trying to find a cure for cancer and that's not coming easy, but you're like spending all this money in that and stuff like that. And that's sort of like one of the arguments. But then, of course, the question that you're faced with is, given that these firms are highly profitable, why are they not allocating a larger share of their profits to R&D expenditures, but choosing to give it to the shareholders, right? Now, in the standard financial theory, right, or in standard economics, if the firm doesn't have any better use for this cash flow, it's always argued that it's much better to give it back to the shareholders so they can actually the financial markets can allocate it into better uses. But if the better use is already here, if the R&D productivity has declined and if the new innovation is requiring much more R&D, then that's not being explained with this data either. The firms are preferring to use a larger share of their profits to make the shareholder payments rather than spend it on the R&D. Now, the issue actually becomes even more complicated because so far we haven't even gone into the discussion of this, but most of the time, even these new drugs are not invented or discovered or whatever they do by themselves, but most of the time large firms are acquiring them from small research labs. I mean, the most recent example that everyone knows, of course, is the BioNTech Pfizer case, right? Pfizer has not produced the COVID-19 vaccine. BioNTech actually innovated it, but then Pfizer, with its sort of like distribution and marketing network and production network, went in and then acquired it. If this is the case, and this is what all the literature on pharmaceutical industry is showing, if this is the case, if these firms are not doing the actual innovation but outsourcing it, then what we're doing in this research is essentially overestimating the number of new drugs that's innovated by these firms, and hence the link between profitability and new drugs, in other words, the link between profitability and innovation may actually be much weaker than what we think, okay? So what does this leave you with? This leaves you with the main argument that I started with. In this case, it essentially means that the absence of a strong link between profitability and innovation means that these firms are highly profitable, not because of their innovative activities, but essentially because of their monopolistic positions and market dominance. Large pharmaceutical firms might actually be acquiring and then maybe developing a little bit and then marketing the drug innovations done somewhere else. So this is one case of the knowledge monopolization, and you can do similar studies if you can get the right data to look at what's going on with this. For example, if you can actually go and get the patent data for the high-tech firms and then figure out a way to analyze how many of those patents are actual innovations and how many of them are designed to protect market power, then you can actually link it with the profitability of the high-tech companies and the rest of the herd. All in all, essentially, what we're showing is not too different from the critical literature on the IPRs, in the sense that they support, they're kind of like in line with the absence of at least a significant empirical link between the profitability of pharmaceutical firms and new drug discovery. So this is the paper. I've got this, if you don't have access, I've got a PDF version on my web page as well. Finally, if you haven't seen this, this is joint research that we've done with Enes Işık, who's at the Department of Economics at UMass. He's a PhD candidate over there. So we're kind of like playing with this kind of data to look at these things. So Basically, it's been 45 minutes or so. And let me just stop here. That's what we planned. So I talk about 40 minutes or so. And if you have any questions, or if you think that this is all, crap and bullshit, and, you have better ideas, I'd love to hear them. Thank you very much for listening so far. Let me just stop screen sharing as well.
Thank you, Hocam, so much. I think this is a great paper. Thanks, congratulations for the paper. I mean, I think this is super important. Like, answering to your question is super important to work on it, because there are a lot of biases in the research arena, that high profitability, link between high profitability and R&D. And yeah, it's like very important to actually see this empirically, whether there's this bias is actually true. So I think this is very important. I mean, you were super like specific, and you detailed it really nicely. But so basically this like research, by the way, I just jumped into the question. Maybe there was another.
I think that's fine.
How this things goes.
I think that's perfectly fine.
Okay. So basically, like this research like goes to research on the link between high profitability and higher R&D, and it's very important. I don't know why we still, like takes a lot of time to, as Mariana Mazzucato also says, there's this like risk is being democratized from the taxpayers, but the rewards that, there's all these profits coming from the R&D, all the, from the purchases, they don't really, the rewards, basically, they don't really get awarded to the taxpayers, which was why I'm saying this, because R&D is an arena that is subsidized by governments. There's a lot of incentives given to these firms. I mean, of course, like there are a lot of investors who is actually investing to this like research and development, but there's also incentive coming from state, and there's this like even adding more to the unfairness to the situation, because then if the profit is not going to the taxpayers, I mean this markup gets increased a lot, then I think it's becoming even more unfair when we are thinking this is also happening in the research and development arena. This is not something that I mean, industry is also important, but this is not something, a normal product, like that happens to have this like monopolization. It's not, it's like a research, and people actually pay for it. It's the same thing goes to the Elon Musk discussion as well. Like of course he's a smart guy. He does a lot of things to do research. I mean, yeah, blah blah blah. But he gets a lot of like incentive and subsidy from government as well, and now he's one of the richest billionaires in the world, and he has this like notion, postmodern notion that he can do whatever he wants. It shouldn't work like that. There's this, what I'm saying is that there is this like law part, right? The regulation part, whether it is even legitimate to have this like shareholders, to have this like investors to actually, have this gain from this research and development. There's this like very important philosophical question that lingers, and it should be pointed out. And of course, as you also said, the macroeconomic part, right? Macroeconomic debate, whether we actually gain as a society, as like a advanced countries or like a less development countries, whether we actually gain from innovation, which has become super important in the last decade, innovation, technology, and things like that. So yeah, I mean, these are my basically comments.
No, these are excellent. I mean, the COVID-19 vaccines was, one pretty much everybody in the world kind of like learned about these issues, in the sense that a significant chunk of that research was already done by the mRNA technology. That was done by funds given by the public in the US, the National Institute of Health, which then opened up this technology to whoever wants to use it to innovate. And on top of that, the Trump administration gave millions of dollars to all these drug companies for spending in that. And on top of that, all the US and the European economies or whatever they had, they were going to buy this. So you have the demand there. You're going to sell like billions of. So all these incentives are there. And then at the end of the day, when the innovation is made, there's first the moral question that you're asking. Let's say this whole argument was true. They needed these incentives, and how much do they need? $1 billion, $2 billion, $10 billion. There's that moral question as well. But that's sort of like, that's true for like most things. But we're not even coming to that question of like the moral, because, there seems to be no link between profitability and then drug discovery. So you're not even like coming to that. And if you actually, there's plenty of literature. Clearly, we're not the first ones to look at this. We're the first ones to look at it from this perspective, but there's plenty of literature that looks at this and shows that a lot of the innovation in the pharmaceutical industry is essentially coming from universities, public research labs, or publicly funded research labs. But then Mazzucato, as you said, shows that this is true for like most areas of innovation, where the driving force is. So you've got like, your summary is good in the sense that you've got two issues. One, whether these arguments are right at all, and in this case they're not. But let's say if they were right, what is the moral limit, right? Are you going to let people die of COVID-19 instead of like opening up the patent to use, licensing it out or not, whatever? We had the same thing during the height of the AIDS, HIV epidemic in South Africa and in Brazil and rest of the Latin America as well, when, so it keeps like just sort of like repeating itself in that sense. So thank you very much for those comments. Yeah.
I mean, thanks a lot for your presentation, I guess.
Yeah. Any other questions or comments or objections, or?
If there isn't any, I can still jump in.
Oktay wants to say something, but.
Hocam, I wonder what is the effect of this R&D on the profitability of or market concentration. So I asked this the statistical result that you showed is what was the direction of that causality from the R&D to profitability or other direction. So I mean that this R&D cost.
The R&D was the dependent variable.
If that's what you're asking.
What if the causality in the other direction? So this does this R&D leads to the R&D leads to the profitability in the future time?
You can look at that.
I mean, we didn't do it in econometric terms, but you could argue that the R&D, I mean, clearly there's a positive link between R&D and the profitability. But then the question is, that's sort of like what we're trying to get at. This R&D is not producing new products, or like producing very little innovation, right? if that is the case, how come R&D is increasing profitability? If, let's say, there's a positive link, then the only possible answer, if there is actually a positive link, must be that it's not contributing to profitability via new products and stuff like that, but rather by producing patents that are designed to protect or to lengthen the previous patent's lifetime, or create patent tickets and stuff like that, so as to provide, you know, the market power. Okay, so you need like another step in between, unless, you know, you have R&D and then the new products and then the profitability. But it doesn't seem that way. You've got the R&D and profitability increasing, but the new products are actually declining. So, you know, that's kind of like, that goes to the gist of the argument, essentially. Thank you. Oh, it's you. Okay. I thought there was a question in the chat, but that's the YouTube address that Oktay has posted. If you want to see, some of you may have already seen the previous and coming attractions in this series, but all of them are being collected under the YouTube channels of the department. So if you had missed any one of them, you can always go back and check those great talks as well. And then, do we have a talk next week as well, Oktay?
Yeah, we have one more session. We have one more session.
Okay. Next week.
Yeah, Matias Fernango. He will talk about the inflation puzzle.
Perfect. And now we're gonna have a
Break, and then there's another set of speakers in the spring semester as well.
Can I ask one more question? But maybe
Unless someone else.
how are we doing in the time? Is it like 1 hour, or do we have time?
No, we're fine. We're fine. We're
Okay.
fine like that.
Maybe this is a bit like out of context question, but like, Hocam, do you believe that is the pharmaceutical an industry where, you know, the market forces should play a huge part, you know, like it's kind of a, you know, sacred industry, you know, you can't really, I mean, we see that this price dynamics are very important in pharmaceutical, because, you know, you need to have this incentive to actually invest in that research and development. But for a person, for instance, how much is, for instance, his daughter's, you know, like drug needs be priced at, you know, it can be huge, you know, there is no limit to that, what you can actually pay for your family, for your, you know, friends, and etc. It's like a very different type of market that, you know, like how this like price parameters is actually playing out is like a different story. And how would you think of that, you know?
I mean, look, if the argument that IPRs are necessary for innovation doesn't hold, right? What is the use of IPRs here? The only use is to increase prices, increase markups, and prevent the entry of other small firms into the. So you could make both arguments. I mean, if you're only going to look at this data, that get rid of these monopolistic, you know, intellectual property rights, and then leave it to the markets, and then let's see what happens. Or you could make the opposite argument, right? You know, if these guys are not doing this efficiently, because the markets are supposed to do this efficiently, but the markets are essentially monopolizing in this case, why not public do this like more, or like, you know, why not public get the benefits of these innovations and stuff like that? You could also think about, you know, of course, when we're looking at these pharmaceuticals, we're focusing on new drugs. If you look at the different types of skin cream and, you know, beauty products and this and that, you know, there's a lot of, you know, sort of like pseudo innovation going on there as well. So at first, when you're talking about knowledge monopolization and how these monopolies are like making extra profits, I think our immediate reaction to this, and we're kind of taught this way, is our immediate, well, why don't we leave it to the market, get rid of it, and have competition and stuff like that? But that's that immediate reaction. Even then, what you're going to be doing is that whatever is profitable, then that's what the private firms are going to try to do. Okay, they're not going to try to do whatever is most beneficial, right? So you have to essentially, in most areas, you have to prioritize the public investment and the public research, and then sort of like open it up to the different. As I said, the COVID-19 vaccines just showed it. Like when the pandemic began, all these patents that were under the control of the National Health Institute in the US, under in the public domain, were made freely available to all the researchers, and a bunch of researchers used this and then came up with the vaccine in a really short amount of time. So imagine this happening all the time. You open up the patents and you open up the technology and all those kind of things. And many people like around the world working on these things are going to come up with these ideas, at different universities and stuff like that. Okay, in the case of BioNTech, it's still a private pharmaceutical lab that came up with the innovation. But in the case of Moderna, it's essentially coming out of a university, right? A research group at a university. So there's different ways of doing this probably, but this is a bigger issue. This is just one case of the role of the intellectual property rights, I guess. And then there needs to be like sort of like a more general discussion, which is likely to happen in the coming decades, as this is going to touch to high tech. This is going to touch to green technologies. If you're actually going to go into if you're actually serious about decarbonization and green technologies and green energy, a lot of those technologies are also patented, and the patenting in those industries are not increasing the prices, but also increasingly making investments in these areas either difficult, expensive, or unavailable in some cases for a lot of developing countries as well. So over there as well, we're going to like run into that problem. So it's not peculiar to the pharmaceutical industry in that sense.
Yeah, exactly.
Alper is asking a question on the chat window. Alper, would you like to answer? Well, ask and answer your own question.
I will, but I'll keep my answer for other meetings.
But at least so that everybody can actually on YouTube as well can hear about your question.
Yeah, the reason I chat because I was taking it my little daughter, so okay. I don't know if she jumps, in the. But my question. Yeah, she's sitting next to me, cool. And she's asking you, when are you coming to, just but there's another question. So the reason I am asking, there's like focusing on intellectual rights and properties and in other components, so it might be another dynamics in particular platform industry or platform capitalism, platform businesses, and pharma industry. Which might, for example, data extraction, data collection, and also even beyond this, right? Even beyond different dynamics, which related this R&Ds and technology. So the reason I'm asking, this framework is sufficient to capture, because it says into like monopoly knowledge, right? Monopoly knowledge. It's so broad, but there's another, for example, what about information? What about data? And can we think the data under this issue? So this kind of, I am also talking about the rent, and the question of rent is also highly problematic for me, but I don't want to go into this a lot.
That's an excellent question. And for those of you who don't know Alper is essentially actually working on these issues, and he's writing an excellent dissertation thesis on different ways that this monopolization process, this knowledge monopolization process, works in the platform economies, taking Uber as his case study. So he's right in the sense that this gives you one sort of like perspective. So, knowledge monopolization clearly includes, especially when you look at the platform capitalism, you look at the platform type of firms, you look at the high-tech firms and stuff like that. Knowledge monopolization is, or like the IPRs are one part of knowledge monopolization, but there are a lot of non-patented, non-IPR protected elements of knowledge monopolization, including data generation or data acquisition, and how this data is generated and used both to secure monopoly, but also to change a lot of production dynamics and even like generate new products and stuff like that. So that's something else that needs to be added to this picture, essentially. So, the short answer to Alper's question, of course, is no, this is not sufficient, but this is a required step in order to understand much of the sort of tendencies as I see in the world economy. So thank you for your question.
Hocam, how do you define data anyway? Like, I'm a bit skeptical about this, like, data, because the discussion started with data, oh, it's data, it's big data, la la la. But what is data anyway? I mean, I'm working at a technology startup right now, and like, data doesn't mean anything to us, even though we are doing like machine learning, natural language processing, and in the backend we have a lot of technical stuff that we are dealing with. But data, I don't know, what, it doesn't really resonate with me what data is. And I've been reading about this. I think Kian Birch, one of the scholars who actually work on this area, they say that they also asked the same question, like, we didn't understand what the data actually reflects on the literature. It's more like assetization of processes, assetization of investments, assetization of certain, royalties, other purchases, and etc. Those are the areas that actually, extract rents from the people who actually develop those, like tools. And again, data was kind of irrelevant in a way, but I would like to hear your opinion on this. And
well, I mean, my opinion on this is that next semester we should actually have Alper as a guest as well in our seminars, so that he's spent a lot of time in figuring these things out and working on this. So he can actually present what he's been working on, and then we can kind of like discuss that as well. You can come up and, the remaining people.
I'm glad to do this.
Yeah, perfect. So a bunch of the remaining people on the Zoom screen, at least following the debate, are very much interested in these issues as well. So that be actually quite fun to have Alper to tell us what data is and how it's related to assetization and different processes of knowledge monopolization, so that I don't exceed, I don't step out of my my borders and step into his territory.
Nice. Great.
But thank you for the questions and everything. I think we can wrap up, Oktay, right? So that people have some time to relax and go to the bathroom, have their drinks, and get ready to watch the World Cup game. Thank you for hosting me. Thanks a lot. Good night, everyone.